I am just trying to imagine if I were somebody who was gambling right now, if I were playing craps, all my numbers are hitting. Well, that's the way I feel like today with today's Mortgage Minute. It seems like all the good news is finally lining up for people who are thinking about buying a home, selling a home, refinancing a home. Well, maybe not refinancing quite yet, but getting a HELOC, maybe doing some work on the house. It's all lining up, and I'm just pretty excited to be here today. I can't wait. I'm kind of giddy, if you will. It's like a first date, except my date has no hair. Let's invite him on. His name is Art Alvarez. He is with MortgageWorks. He is the genius behind this show. Hey, Art, how you doing?
I'm doing well, Jeff. How are you?
Good. Are you
Yeah,
giddy
there's
today
definitely some
too?
jubilation this week, I think. What's that?
Yeah, it's pretty exciting stuff. I'm not gonna spoil any stuff, but hey, you know what? Something happened today. You overcame obstacles. Technical stuff. It's one of those things like the show must go on. I appreciate you hustling today and driving back and forth across town. And Art had a little issue today. You want to share that real quick?
Yeah, I discovered this morning, actually late yesterday, but my laptop was starting to have some issues, and this morning it just wouldn't power up at all. And so, of course, I have a IT vendor that I use, and so he came over and tried to troubleshoot it, and get it back to operating, and he wasn't unable to. So, yeah, we had to do a little pickup and delivery with another machine in order to be able to, get the show on the road at the appropriate time.
I just cannot imagine not having today's show with everything that's going on. And with that, I want to turn it over to you before I let you go, or before I dive out of here. I want to remind people this is a live show, meaning Art is here to answer questions. If you have questions during the program, you're thinking, hey, that sounds like me. I have a little bit more I need to know. Put them in the comments. I'm going to be in the background and I'll be grabbing those comments, put them on screen. Art loves those kind of questions. So please put that in there. If for some reason you're not live, you're watching it recorded, do the same thing. Art will follow up with you and get you an answer, because this is the home of MortgageWorks, where they have the answers. And Art, what do they say?
They're on the house.
That's right. So with that, I'm out of here. Art, have a great show.
All right. Thanks, Jeff. Hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As Jeff and I were sort of kidding around about, it's been a jubilant week in the financial markets, in particular the bond markets and the interest rate and mortgage rate markets, which we're going to touch on here in just a minute. And as you know, I'd like to start off with giving you a little bit of an update about the bond market and the interest rate market. This week, it's all about inflation data points and the Fed meetings, the last 2-day Fed meeting of the year. So that's what this week was all about. And it's now showing, when you take a look at both our rate grid on our website, there's the rates right there. Jeff just pulled them up. We're now in the very low sixes for conforming loans. We're now back in the fives for FHA, VA, and 15-year conforming loans. We're getting into the low sixes for jumbo 30-year fixed. And look at the very top of this rate grid when you look at the temporary buy downs, the 3-2-1 and the 2-1. So if you're able to structure a purchase deal, or if you're a seller, if you're able to help a buyer buy your home, and you're going to use a 3-2-1 buy down as part of the transaction, you can get a conforming loan with a first year rate back to the old days of 2020 and 2021 of 3.25%. So keep that in mind. Definitely, trending in the right direction. And where this is really visible is on the 10-year bond yield chart. As you know, that's what I suggest is your best barometer for tracking mortgage rates. And this chart really looks nice this past week, given that drop in yield that you can see there. Look at that. I mean, we were up over 4.2, and now we're down to, at the late today, down to 3.92. So that's a direct that's direct evidence of why those mortgage rates on our rate grid are so much better than they were a week or two ago. Now, in that respect, so what happened to actually cause this kind of pretty significant improvement? Couple things. First is the CPI. That's the first inflation data point. CPI, you all know by now probably, Consumer Price Index. That's considered inflation at a retail level. Slight increase in November. but a slight decrease year over year. That's what the YOY is, year over year, slight decrease, 3.1% from 3.2% year over year. Then the producer price index, that came out the next day. It came out yesterday. Pretty much flat line for November, and an actual decrease year over year of down to 0.9 from 1.2 previously. So those were two pretty good indicators that we are past the worst of it as it relates to inflation. And so, of course, the Fed also concluded their 2 days of meeting yesterday, late morning. And of course, after that, there's a press conference with Fed Chairman Powell. And his comments also provided lots of celebration in the markets. He did. I've got a couple of quotes here from him. We are likely at or near the peak rate for this cycle. So that's obviously a pretty strong signal. And he's also saying inflation has eased over the past year, but remains elevated. So he tried to keep that little bit of a cautious tone, like, hey, we're seeing improvement, but we're not over yet. And he's still keeping rate hikes on the table, but now suggesting it's much more likely. But given all this jubilation, like I did last week, I just want to point out, this is all good news. Obviously, we want this kind of trend, but we're only back to where we were in early July. And of course, now with today's improvement going back under 4 on the 10-year yield, well, we were at that level in the high 390s in June of this year. And of course, I can recall in June, not everybody was jumping up and down about a 6% mortgage rate, but we're basically back to that level. And so, yeah, that should give us definitely something to cheer about. And I think it looks like is going to be maybe an ongoing trend. But in that respect, given what's happening, I've still got this bullet point: will buyers and sellers capitulate? We're starting to see evidence of that. I'm seeing more activity in terms of pre-qualification requests. I think we're seeing more buyers who are starting to realize we're at where we're at. We are seeing some improvement. Maybe now is a good time. And keep in mind, folks, more home prices really haven't fallen that much over the past year or so. And if we get a few more buyers getting out there, kicking some tires, looking at some homes, getting pre-qualified, just that little bit of uptick in buyer activity could put some pressure on prices because we're still lacking sufficient inventory. So keep that in mind. The other thing I want to point out is, given those buy down rates you saw on our rate grid, this is a great time to get a pretty low note rate on that 3.21 or 2.1 buy down, get a start rate in the 3s or 4s. And because this, improvement in rates, I think, is going to be gradual, you'll still have that 2 to 3 year window to refinance into a lower note rate ongoing. So keep that in mind. The other good news about all this in terms of the inflation numbers improving, the bond yields improving, and the fact that Fed did not raise the Fed funds rate again, which hasn't happened, by the way, since July. HELOC rates, they're very stable now. HELOC rates have not gone up in 5 months now. So though I never argue you should time the market, if you're still on the fence about a HELOC, now would be a great time to consider one, because I think we definitely have hit the peak on the rates for those. And I think with the Fed now talking about lowering the Fed funds rate maybe 2 or 3 times in 2024, you can grab that HELOC now and ride that rate decrease down, because your HELOC will adjust with that right away. So keep that in mind if you've been on the fence about a HELOC. So with that, I want to bring Jeff back, because we have a couple of interesting questions this week that we want to go over on our Q&A session.
Yeah, I keep thinking about the example we talked about last week. Is like the water is warming up, right? And we're excited. More people are going to be diving that pool. So, I think it's exciting, because I even noticed on the way back from Palm Springs today, heading back to La Quinta, I actually saw some open house signs, activity, like people were there. It wasn't that lonely agent sitting at an open house. It was really good. So yeah. I think it's got some people out there thinking about this, Art.
I think so. And despite the holidays, yeah, there's a little bit of uptick in activity. So that's I think a very good sign going into the springtime. If we can maintain this kind of trend in rates dropping, but I caution on that, because the market has a way of, sometimes you think everything's great now, and here and there that could cause that trend downward to be extended and take a little bit longer than maybe everyone hopes.
Yeah, it seems like the play there is taking advantage of one of those buy downs, those temporary buy
Be having
downs.
some technical
Like,
difficulties. Jeff, are you there?
yes, I'm here. I do see you cutting in and out a little bit. You might have a little issue with your internet there just a little bit. Are you there? We see you, Art. Um, we'll see what it looks like. It looks like Art might be having a
There you
little
are.
internet issue. There he is. Here we go. I'm saying it could be a good play. Feels like it would be
Oh, is it
the
on my
temporary buy
end?
down. I think it is on your end. I just checked my internet speed. We're up around 500 megabits per second, so we should be in good shape over here. But are you ready for some questions? I'm not sure he's getting me. We don't want Jeff to run this show, that's for sure. Are you there? We do see you, Art. You know you got a good solid
Can you hear
picture.
me,
We
Jeff?
see you. Yes. Yes. We might have gotten out the most exciting news of the day, and really the most important news of the day, of the fact that the rates in the 10-year continue to drop, and showing the rate grid from MortgageWorks shows some
I'm not getting.
incredible stuff. Are you there?
Yep, I'm here.
Great, great. Okay. All that time we saw you, you couldn't hear us, but we could hear you and see you. But you're back. Are you back?
Okay.
Okay.
Well, that's good. I'm back.
Okay. So good. So I got
At
a
least I
couple of
think I'm
questions.
back.
Okay,
Okay.
we got a couple of questions this week, and it's really comes with the FHA and the rental income from ADUs. And you kind of mentioned this a little bit last week, and maybe the week before last, when we were talking about using rental income. And the recent news reports have mentioned that FHA has changed their rules about using rental income to qualify. What was that change, and how does it help prospective home buyers? We're excited about that.
Right. I had hinted at this last week when we were talking about the fact that the two quasi-governmental agencies, Fannie Mae and Freddie Mac, who buy conforming conventional loans from lenders, had changed their guidelines to allow for only a 5% down payment on multifamily units, specifically duplexes, triplexes, and fourplexes, 2 to 4 unit properties. And that was a big change. And the whole idea was to encourage more purchase of that kind of property in an effort to help buyers, particularly maybe first-time home buyers, be able to purchase a home that will have the additional feature of generating rental income while they're occupying one of the units. Because in this new guideline with Fannie Mae and Freddie Mac, lowering the down payment to 5% when it was previously 15 to 25%, the whole idea is to allow somebody to be able to purchase that home with a lesser down payment, and then again generate additional rental income from one of the other units. But there is the requirement that you have to live in one of the units. Well, this question about FHA that we received is regarding a change that FHA has announced, which is along the same, basically along the same vein in what the agency, in this case FHA HUD, is trying to accomplish. And so what they recently announced was that FHA is now going to allow someone who's purchasing a home with an accessory unit, an ADU. You can now use, when you're qualifying to finance the purchase of that home, you can now use rental income from that ADU, from that accessory unit. And you can use 75% of that as part of your qualifying income. Now, the requirement is that the lender, in underwriting that scenario, is going to have to verify what the monthly rental income is, what the market monthly rental income is or going to be for that unit. And that will typically be established by either an appraisal report that includes an additional addendum called a 1007, where the appraisal will be tasked with the need to determine what the market rent is for that particular accessory unit. And then whatever that number is, we can use 75% of that. Additionally, maybe the unit's already occupied by a tenant under a existing lease agreement, then that can also be taken into account. Although typically you'll want to get a 1007 most likely anyway. So it's a big benefit. The idea, again, here is to try to help homeowners, particularly first-time home buyers. Now, of course, in this case, FHA is not, you don't have to be a first-time home buyer. You can occupy 2 to 4 unit property, or in this case, a single family with an ADU. You don't have to be a first-time home buyer to buy that with 3.5% down, depending on what the price level is in your county. But the point is, this is another way to help a home buyer be able to accomplish home ownership, but at the same time acquire a property that is going to provide a rental income stream to help offset what the mortgage expense is going to be when you finance that purchase. So it's a really great revision to the FHA guidelines, and I'm pretty excited that I think it's definitely going to help some younger buyers, younger families, again, who want to get into home ownership, but would like a little help in terms of some rental income to help offset that mortgage payment. I think this is going to be a great tool to use going forward. So we're excited about it.
Art, there's a follow-up question on this, just a short one. It's what's the difference between a casita that's already on the property and an ADU? Or is it basically the same now?
Well, yeah, that's a good question actually, because a casita can have a couple of different meanings. I think historically, oftentimes a casita would be some sort of detached unit, on a lot alongside, say, a traditional. So oftentimes a casita in that respect wouldn't maybe be a fully livable separate unit. And what I mean by that is a lot of times those casitas might have a bedroom, a bed, and it may have a bathroom. Oftentimes, maybe just a half bath, sink and a toilet, maybe some counter space where you can plop down a microwave or something. But as opposed to an ADU, and particularly the ones I would argue that are most of them that are getting built now, they're essentially can be fully functional, livable units. So they'll have, bedroom, basically touching all the requirements, bedroom or a bed, bathroom, including bathing ability, and a kitchen, a functional kitchen. So in that respect, an ADU really gets more into that kind of a definition in terms of a property type. And of course, that's the one that's going to be more attractive as a potential rental unit to a tenant, is something that, of course, is fully livable, and you can, eat, sleep, prepare food, bathe, have toilet facilities, all that in one separate detached unit.
That's a great clarification, and that makes much more sense. This next one is coming from a viewer. They have an interesting question about reverse mortgages. And they say, the question is, has demand for reverse mortgages been dampened by the rise in mortgage rates until today? The past couple of years, I put in today, but the past couple of years.
Right. Another good question. And it's an interesting question because, in this last couple of years with, first mortgage rates having gone up so much, that's been all the talk, right? But you don't really hear much about reverse mortgages, and to what extent is that product, been damaged, if you will, or have we seen a significant drop off in loan volume like we have in the first mortgage segment of the market? Well, the short answer is yes. There has been a big drop off in reverse mortgage origination activity. And in some respects, very similar to what we've seen in the first mortgage arena. A big culprit, of course, is refinancing. And that brings up something that a lot of folks don't understand or maybe don't realize. When you get a reverse mortgage, it is possible, And in some situations, some particular environments, interest rate environments, it would make sense to refinance your reverse mortgage into a new one. Now, the most common reverse mortgage product in the US is it's actually an FHA product administered by FHA, which of course is overseen by HUD, Department of Housing and Urban Development. And that core reverse mortgage product is called a HECM, Home Equity Conversion Mortgage. Well, when rates dropped so much in 20 and 21, that caused an explosion in what is called HECM to HECM refinances. So there was a big increase in refis, not just in the first mortgage market, but in the reverse mortgage market. And those homeowners were looking to refinance their existing older reverse mortgage into a new one for a couple reasons. Well, actually, a primary reason was to be able to get a larger loan amount, which is in part was made possible by the lower interest rates that we had during those couple of years. So a lot of that activity occurred. But what's interesting is in the reverse mortgage market, refinancing in that segment is really historically not been that prevalent. It's not ever been that big of a part of the overall origination channel. Unlike first mortgages, we definitely can have refi markets. Those come and go. We've seen many of them. Reverse mortgages, I would say, are a little more insulated to that, but it was really pronounced in 20 and 21 because rates were so low. So now, since that time, the overall reverse mortgage loan volume has dropped, considerably by 50% or more. But when you peel away the HECM to HECM refi activity of 20 and 21 and just look at what they call the standard HECM or reverse mortgage activity, which is using a HECM for a purchase or getting a HECM because you have a home that's got a huge amount of equity or is free and clear and you don't have an existing HECM, those are the standard HECM transactions, a purchase or a first-time HECM borrower. Interestingly, that segment has remained relatively stable even as we've gone into these higher interest rate levels. So that speaks to the fact that even in higher rate levels like we're experiencing now, a reverse mortgage has lots of benefits, and there's lots of reasons why you shouldn't be discouraged about current rate levels as you might have been with a first mortgage refinance. And even at these higher rate levels, there's actually a little kind of a secret benefit a lot of folks don't realize about reverse mortgages having to do with a line of credit. But that's something we'll touch on probably next week in another episode. Jeff, back to you.
Yeah, great information. That's something I wasn't aware of. That as you say, it was very stable. The reverse mortgage market, even with the rates changing the way they are. We do have a little short video that timing is perfect. I think we finished this up last night. Let's see if we can get this to play properly.
Or maybe your home is free. Okay. You've thought about a reverse mortgage. You've seen lots of information about them, but you're still unsure. You still have a lot of questions and a lot of concerns. Well, I can help you with that. With a simple loan assessment, I can show you how reverse mortgage can be an integral part of your financial future. And do I believe in reverse mortgages? Absolutely. Way back in 2006, I arranged one for my father. He had a monthly check that he received for over 14 years until he passed away. So again, I can help you with a reverse mortgage loan assessment to show you how it can work for you. My information's on the screen. My name is Art Alvarez. I'm at MortgageWorks, where we do have the answers, and they're on the house. Call me today.
Yeah, so this the whole idea of having an assessment done is a great idea. And as Art said in the video, give them a call. Find out if you're right for this. Just take a second, because you said, hey, if you're a senior, the fine is is am I 55? Am I 60? What's the age limit on a reverse mortgage? What's that whole setup?
Well, the core product is the HECM. That's where a majority of reverse mortgages are. That's the product that a majority of reverse mortgages use. But and for that product, the minimum age is 62 for eligibility. Now, one thing to understand about that is, of course, in a lot of cases, the borrower is married. There's a couple. And so only one of the two borrowers has to be at least 62. So you can have someone who's meets that age requirement, but has got a spouse who's below 62. Those two folks, like a married couple, are still eligible because one of them are 62 or over. However, it does affect your proceeds for that reverse mortgage because it will be based on the younger spouse who is under that 62 limit. In addition to that, reverse mortgage lenders, some of them do have, and the one that we deliver loans to does have a proprietary non-FHA reverse mortgage product where they can actually allow a lower age threshold of 55. So for some of those homeowners who are nearing that 62 number, but they're not quite there yet, but they think they may be have a scenario where a reverse mortgage might make sense for them, they should certainly give us a call because we can help them with that as well if they're at least 55.
Great news. I'm just trying to bounce off of there just in case I'm taxing your internet there in between questions.
Okay.
I'll turn this back to you because we have the last week's closing question, and
Right.
then this company's closing question. So I'll turn it back over to you, Art.
Okay. Thanks, Jeff. Okay, now we're going to go to last week's closing question, which you have it, you see it there on the screen in the yellow bar there. On a conventional loan, will I get a better interest rate if I put at least 20% down? Good question. It's a common question. As you probably know, just in general, in terms of the mortgage industry, the real estate industry, and all the financial news, there's been this thing about the magic number in terms of down payment is 20%. That is sort of the holy grail of if you can put 20% down, then almost anything's possible, and that's where you're going to get the best deal on the rate. Well, I decided to cover this question because the answer is actually, with 20% down, is that going to get you the best rate? Well, no, it's not. Now, don't panic. That doesn't mean you're going to get a rate that's a lot worse. We're talking here about very small degrees of difference, but technically it is true. A 20% down payment is not where you're going to get the best pricing on the loan. So as an example, I want to just go over this as it relates to conforming 30-year loans. Conforming meaning being sold to Fannie Mae, Freddie Mac. So for conforming loans being sold to those two agencies, the pricing of that loan is a big part of that's going to be based on loan to value. That's what you see there on the screen there, LTV. That's loan to value. So the first thing to know is to get the best possible pricing treatment of your loan application based on loan to value is you want to be at 60% or below. So that's 40% down or more. That is going to be the absolute best pricing tier as it relates to loan to value. Now, you might think so does that mean that the second best pricing tier is where that 20% down payment falls? No. The second best pricing tier is going to be if you're over that 60%, but up to, not exceeding 75%, or if you're over 80%, 81%, up to 90%. So if you're in either 61 to 75% loan to value, that means, of course, 25 to 40% down payment. Or if you're at 81 to 90% loan to value, so that means less than 20, 19% down to 10%, that's where you're going to see the second best pricing tier. And so where does that leave the 20% down scenario? It's actually in the third best pricing tier. So if you're putting less than 25% down, so 24.99, and even if you're putting, less than 20 down to, 14.99% down or 15% down, that's the third best pricing tier. Now, like I said, don't panic. The spread between these tiers is not significant. Each tier is about an eighth in rate. So in other words, if you're putting 40% down, you're probably going to get a rate that's about an eighth better than if you're putting 25% down. And that's going to be another eighth better if you're only putting 20 or 15% down. So the spread from that best tier, 60% loan to value, to the worst or third tier in this example, that's 76 to 85% loan to value. That spread for that whole section, it's only 0.25%. So again, not the end of the world, but I just wanted to basically debunk the myth that 20% down, not only is that going to help you qualify when maybe you're having trouble just because of the down payment, because that's not always true. But the other thing, that if you're thinking you're going to get the best deal on the rate with that 20% down, that's not quite true. You can do a little bit better. But of course, the trade-off is you need more money down, and you may not have that, or it may not make financial sense to use that additional money just for an extra eighth or quarter in rate. So I do want to make sure that you're aware of that too. Because in a lot of cases, I'm not suggesting you should just put 25 or 40% down just because of this difference in rate, but I think you should know that that's how it works. Okay, with that, we're going to go ahead and go into our last slide, which is the closing question for this week that we'll then answer next week. And it's a little bit more about reverse mortgage. I'm a senior homeowner with a home free and clear of a mortgage. I've been considering a HELOC. Remember, that's a home equity line of credit, or a reverse mortgage to pull out some equity, and found out that a reverse mortgage can include a HELOC. Is that true? Well, that's an interesting question. I think you're going to be very interested in the answer, and I'll have that for you next week. And remember, the answer, it'll be on the house. Jeff, back to you.
I just love these cliffhangers. Like, what's going to happen? Who's going to get a HELOC? Should it be a reverse mortgage? What should it be? That's a great question, Art. Thanks for sharing that.
Sure.
It's always fun to have good, positive information, especially when it seems like the market for the last 9 to 12 months has really been locked up. And I know, as you said, hey, these rates are not like, they were like that in June, and people were still hesitant. But we kind of said, well, maybe that's because the water felt frigid, and now they've gotten adjusted to it. And let's face it, some of the other things that have played into this are, the gas prices have gone way down, and that puts more money back in our pockets on a daily basis. Which all of a sudden now we're thinking, hey, we can afford maybe a little bit higher mortgage because rates on rentals have gone up. So all these factors go in to it, and you see Art's information on the screen, and he is the wizard of what to do next when it comes to mortgages. It's 760-883-5700. That's his office there in Palm Springs, and of course you can always call him on the cell at 714-612-9035. Always go to the website and check out the rate grids, and below that, the rate grid, you'll see all kinds of options for calculators. You go there and see what happens. Hey, how much do you have to put down, and that type of thing. Should I do reverse mortgage? There's a lot of neat calculators on there. And of course, you can always send Art an email at art@mwloan.com. Art, any news we need to be aware of that maybe slipped under the rug since we've been on air that we should share with the audience?
Nothing else I can think of now. I think I'm looking forward to next week when we talk about that closing question, because I could easily see that turning into the whole show, because there's so much good information there, and some information that I think a lot of folks are just not fully aware of and should be thinking about, particularly if you're a senior homeowner and you're still on the fence about a reverse mortgage. I think there's some benefits that they really need to understand. So.
Well, in your video, you talked about how, you're such a believer in it. Back in 2006, you helped your father get a reverse mortgage, and it made such a difference. What do you say, like 14 years of monthly payments that he received, which I would think would make a huge difference in someone's life.
Well, it did for him. Just real quick, I can say that, at the time I found out a couple of things. He was sort of letting it be known he had a little bit of negative cash flow in his monthly, budget between his, Social Security, small pension, et cetera. And yet at the same time, I discovered he had a small mortgage on his house, about $120,000, about a $900 a month payment. So while on the one hand, he was complaining about having some negative cash flow and having to dip into his investment account for living expenses, I then found out he was paying extra on his mortgage. I'm like, Dad, why are you paying extra on your mortgage when you're complaining about you've got some negative cash flow in your monthly budget? And he says, well, I'm trying to accelerate paying down the loan so there's more equity there so that you can have something to access when I get old. Now, mind you, he was saying this when he was 80. So I then proceeded to tell him about a reverse mortgage. Like anybody, including my own father, and I'm in the business, he was hesitant. It took a while. I had to really go over it with him in detail. He finally got comfortable with it. We got it done in '06. Yes, home values were very good then. 80 years old, he got a good sized loan amount. It paid off his existing mortgage, got rid of that housing expense. And then he set up lifetime monthly checks of almost $1,000 a month.
Wow.
So that was almost a $2,000 a month swing in his monthly cash flow, so he could live comfortably and not have to tap into his investment account anymore, which he was actually pretty good at managing. So he lived to be 94, and he got a check every month with it like clockwork. And it was probably the greatest thing that we could have done for him at the time. So it really, really worked out well. So I'm a big believer in the product, and it has so much misinformation. There is still, even today, even with Tom Selleck and all the other celebrities you see on the commercials, there's still a lot of misinformation, misunderstanding about the product. And if I get a chance to talk to anybody and really help them understand it and talk in basic, easy language, usually the light goes off and they realize it's a really good thing to consider.
Well, thank you for sharing that. And we look forward to hearing more about that next week on the show and having an answer to that next week's question. Make sure to get a hold of Art, 760-883-5700, or again, 714-612-9035. As the rates fall, Art, are you going to be turning your cell phone off for any reason, or should you be on and you're taking calls anytime during the day?
No, I'll be leaving it on because there seems to be a little bit of even interest in refis, believe it or not. So no, that cell phone's on 24/7.
That's fantastic. Art, thank you again. Great show. We look forward to seeing you next week. And with that, I'll sign off.
Okay. Thanks, Jeff. Thanks, everyone. Thanks for watching this week's Mortgage Minute. My name is Art Alvarez, where we do have the answers and they're on the house. Take care. See you later. We'll see you next week. Bye.